Alright, folks, welcome to this week's Forex commentary and market review. Before I start, I'd like to say for the number of persons that have showed interest in Discord, I think there are about 9-ish now, and what I'm going to do is that I'm going to drop the link to a Telegram channel. The Telegram channel is going to be like a wait list so that I can have everyone in a particular place, so it's a lot more easier to do things, because before now I was telling the people that texted me that they should remind me by the end of the year, and I think that doesn't make sense. It just shows I can't handle this thing. So but I thought about it and I just figured, why not place everyone on a wait list, and maybe whoever else is interested and they don't want to send a DM and stuff, well, I'm gonna put the link in the description below, and that's that. So this is the dollar index here on the monthly time frame, and before we begin, kindly like and share this video. Don't worry, I think we're gonna have a nice time. So this is the monthly time frame on DXY, and we said a number of things last week which we are going to talk about, right? And we're also going to learn a few lessons from last week's price action and build more narrative for this week's trading. As you see on the monthly time frame, this is we have like 5 days left, so one more week for the end of, or until the end of November's trading, and it's been a rock actually. But if you look closely here, you see currently we're already seeing the markets print upside on DXY, and that's one of the things we talked about in previous commentaries when we said the high time from institutional order flow on dollar index is bullish, and we kind of like used a number of things to qualify this narrative. Okay, we looked at the dealing range from here to here, and we talked about levels on the monthly time frame, for example, like less fair value gap as a draw on the query, the long-term draw, and we talked about other levels like the 3-month fair value gap that we wanted to see prices trading to, which in fact they did, and the market returned back inside the range. Now the reason for this recap is because I had a few people, funnily, and it was quite interesting that I think 3 people messaged me last week, 2 on Instagram, 1 on Twitter, talking about that they're watching my videos and they are not clear about some things. And the only thing I told them is that while I cannot fix your questions with one audio, I can just encourage you to follow the commentaries, because when you follow the commentaries, you're absolutely going to understand the way I talk about this market, or the way I view this market, right? So currently the dollar index is currently printing bullish, and the idea for December would be for us to stay above this consecutive down close candle, this 1-2 candles. If the markets can stay above and close above these consecutive down close candles, then that gives us our straight one-way ticket that December is likely going to be bullish on the XY. But that's future prognostication anyways. But last week we talked about very specific things we wanted to see in the markets. We talked about the fact that we were at the weekly level, which is the weekly fair value gap, and there's something you'd want to understand, that the thing about markets, aesthetics don't matter, because if when we go into lower time frame and when we recall the things we said last week, for example, let me quickly rush to the lower time frame. We talked about how these levels were clean, how this level itself was clean, but then again, I said something. I said there's only one fact which is very certain, is that we are at the weekly fair value gap 1, and we were trading above the 50% of the weekly fair value gap 2, and what we want to be interested in is the change in the state in delivery, meaning since the markets were showing the likelihood for an expansion this week, all we need to validate this week's buys is to see a change in the state in delivery, which is on the 4-hour time frame. And not just that, I also said that we wanted to see our Monday trades, because last week candles closure didn't give anything into bullish DXY for the new week, except how they interacted around key levels, right? That was the only way we could use to validate, okay, there's a likelihood there's a likelihood that DXY continues to run higher. So when somebody comes to you and says identification of liquidity is how you learn technical analysis, just tell them that they're wrong. You point situations out where market leaves clean levels out and still trades, because there are more times for you to be right on bias than for you to be right about how the markets are going to trade. Now, I said two different things. There's difference between bias and there's difference between how you want the markets to trade. Bias is kind of like a little bit easy, because you can look at data. For example, you can look at COT agent program. I think it's been a while since we talked about COT, but there's no point talking about COT every now and then, because everyone has them on their chart, and we can see currently DXY is very, very bullish. And if this is your first time coming across my YouTube channel, you can go to mentorship, right? The first video I talked about how they came about this indicator for the COT agent program. So you might say, oh, it's an indicator and stuff like that, but I manually went to barchart.com and I did all of these things, so you can understand that it was an ingenious work by 2 Degrees, the guy who did this stuff. So while we understand that the COT is bullish, well, that in itself gives you a premise for how you want to look at the markets, because now that you know the markets are bullish, so it means whenever markets returns into a discount, you can expect a continuation, or whenever market sweeps an old low or runs below a key low, you can also expect or anticipate a continuation to the upside, because the high time frame institutional order flow is bullish. Now, a sweep below an old low can come in various forms. It can come in form of maybe a run below the previous weekly low. It can come in form of run below previous day's low, probably after you've established that the weekly bias is bullish. So when you see a run below previous daily low in the context of a bullish weekly draw on liquidity, then that's bullish, because there are periods when the high time frame institutional order flow and the draw on liquidity are diverge. Okay, what I mean that they are diverging in the sense that the periods of retracement, for example, when markets are poised to return back inside the range and you say a run below this low, for example, it's a Taurus soup. No, you are likely to be wrong, because when we called out this retracement after the markets trade into the 3-month fair value gap, we wanted to see the markets return into these consecutive down close candles. So there's a blend in direction, there's a blend in levels, and all of those things put together, including, I mean, when I meant direction, I meant the high time from institutional order flow. I meant the high time from draw on the query. Okay, so when somebody tells you that, okay, when you can identify liquidity on the market, that's how to trade. I'm sorry, the markets can absolutely trade however the markets want to trade. And that's why I said there are more times for you to be wrong about how the markets are going to trade than for you to be wrong about direction. I've seen lots of folks tell me that, okay, Settle, I called this bias, but I couldn't participate in the market and stuff like that. And the singular reason for that is because while you're right on bias, you absolutely needed the market to trade the way you wanted the markets to trade. And because of that, you have a huge expectation about price delivery. And what you don't understand is that the markets will absolutely trade the way the markets want to trade. The market doesn't care about your feelings. The market doesn't care about your emotions. The market doesn't care about how you want it to look. It will just absolutely trade the way it wants to trade. Now, when we look at the daily time frame, and the other talking point from last week was, since we had a fair value gap here, this was an old fair value gap, which became an inverse fair value gap here as soon as the markets started to trade above, right? So when we fell back inside the range of this, from this high here to this low here, and we're inside this gap, so it was obvious we're within another key resistance level or a key price level. And because it never turned into resistance anyways, you can see the bodies of the candles never closed below, so it was just simply a key price level. I said, so long we stay below or consolidate inside this gap, we will not be looking for upside on the XY. We want to see the market stay above this gap. And how do we want to see the market stay above? It's on a closing basis on the daily time frame, not on the 4-hour time frame, because we are looking at it through the lens of the daily chart. So we want to see the daily time frame respect this gap, and from there we begin to build narrative about how we want to engage. First off, we want to see them stay above this gap and see if it validates a change in the state in delivery. Now, why is this a change in the state in delivery? Because here, look here, we have a low here, markets traded below this low. This is the last down candle prior to the run on liquidity here, and the markets traded into this consecutive down close candle here. And as soon as this candle closed above the bodies of this candle, that's a change in the state in delivery, which means we have a market structure shift. You can see this swing low here. You can trust this swing low, no matter how hard it is to trust it in real time. Now I'm going to check, just go through my Twitter account, and I'm going to show you what someone posted, because the kinds of things I teach, basically it's open source. And when we say something is open source, it means everyone can build on it, or it's not centralized to the mentor or the educator alone, meaning someone else can look at their charts and see exactly the things I'm saying. Okay, it's not, you wouldn't need me to confirm what you're seeing in markets. Okay, you would not need me, absolutely not, because what you're seeing is exactly what I'm saying. Okay, the reason why I'm referencing this chart is because he made a post and recalled the kind of the things I said in the commentary last week, when it was like, as explained from our recent commentary, price trade into the weekly fair value gap. Okay, this was weekly fair value gap, highlighting the midpoint of this weekly fair value gap, and saying you want to pay attention to how the bodies of the candles are above the consequent encroachment of the weekly fair value gap. Daily key level volume imbalance is holding price for higher trend, 4-hour time frame change in state in delivery, established DXY buy. And I want to look at my comments on this post, because I made comments on this post, and that's what I want to pull out. I think I'm gonna click this. I think that's what I'm clicking. Alright, so this was my comment on the post. I said, yup, even though I'm hardly comfortable with intraday price action. He said what he said. Now let me go to euro, or stay in dollar index. So we're going to see what it looked like. Okay, my head is spinning to 40 degrees right now. So this was intraday price action, relatively equal lows, and we have all of this consolidation. And while we had a change in staying delivery on daily time frame, apparently I wasn't comfortable with the market, and because it was obviously consolidation. And I'm going to show you how I engaged the market last week, and what made me engage in price action, because on this day, this was Monday's trading, so I had to wait until Tuesday. Yes, I waited until Tuesday. I wanted to see very, very specific, price action details on euro before I engaged. But that's all for last week. We're going to revisit it when we go to euro USD. That's for recap. Okay. So for this week's buys, we're still very bullish on the dollar index, and we've been calling 154 level for weeks now. Right, we said low resistance, liquid run. I think the markets can easily reach for buy side here, and the bodies of these candles here, the rejection block here. So that's the highest closing body. That's the rejection block. Okay, so this is the rejection block. That's 197.6. Okay, but for aesthetics, okay, we just want to have fewer levels drawn on the chart so that everyone can easily see what I'm trying to point out. So we have a bullish close on the weekly time frame, and we also said the monthly bias is bullish. So the weekly time frame being bullish now validates the monthly bias. Okay, it's the same way a bullish dollar index on Monday, a bullish close on Monday, but not just any randomly bullish close. Okay, think about the details. Okay, you want to think about the fact that we stayed above this inversion fair value gap. If someone asks what's an inversion fair value gap, well, it's simply a fair value gap that switched roles. Okay, this was a gap used for resistance here, resistance here. As soon as the candles close in terms of bodies, okay, it switches role from an actual normal fair value gap to an inversion fair value gap. Okay, so for this Monday's close that validated last week's bias, you want to see that we traded above this inversion fair value gap. There was a change in state in delivery. We had a bullish order block that the market's traded inside into. Okay, and that's what makes this a confirmation tool here. This candle, that's why it confirmed last week bias, because it wasn't just a randomly bullish candle, because in the commentary we had a bullish candle from Friday, but it's only if you want to take a bet you can say, okay, Friday closed like this, then you're going to be bullish. But no, I would not do that, because one of the things you're learning is how to build narrative, not just build narrative, how to build high probability scenarios. Okay, right now, right now, most of you already understand that it's extremely difficult to create an environment where your trading model can flourish, because not only technical skill, you need patience, and all of these things are doesn't come easy, especially when the candles start printing during the week. Lots of emotions flying out. So what you're learning is, how can I build narrative that if I take a trade, I'm likely to make money. Not high probability order blocks, which, I mean, it's just one of those things on the side, but it's not important at all. Okay, someone teaching, okay, let me show you a reclaim block, how I made 10,000 US dollars on a reclaim block. You think that's what's going to really change your trading? No, absolutely not. Okay, you need to learn how to build narrative. And one of the most insanely complex and difficult markets to learn from is learning from currencies, the majors, especially dollar index and euros, because they're heavily manipulated markets. If you can take all of these ideas and put it in gold or silver, for example, and you stock those pairs until they are willing to move, you're going to make a whole lot of money on those pairs. But currencies, very, very stressful, extremely stressful. But if you can learn it here, because this year alone I've seen the worst market condition in about 6 years of trading, and I hope it gets better from here, because it's not cool. It takes extra effort, it takes extra level of patience, it takes everything, it takes it extra for you to make money trading currencies. And that's why you're learning it this way, because I don't think there's any other way the markets can respond to logic, if not in terms of probability. Because probabilistic thinking is the only logic these markets understand, not the buyers and sellers. All those are complete bullshit, really. And that's why when we talk about these things, we talk about order flow, and we can differentiate the difference between a retracement, and we can recognize what sponsorship is in the line of in line with high time frame bias. So currently we want to see DXY run higher. Now you can see we are above these consecutive down close candles. That's another symbolic representation of a bullish price action. And what is next is, how do we observe where the markets are going to trade? Well, for one, dollar index is bullish, and dollar index could literally open up next week and begin to rally. That's fair. But also there's a level here. We have this volume imbalance, and we have this sell side imbalance, buy side inefficiency, and we have this BC. And you can see the candles, okay, all close within the range of Wednesday's candle. Although they are bullish candles, okay, they are bullish candles, but indecisive candles. So I think the market might have some level of interest here, and that's only going to take London session, the overnight session, to validate if the markets are going to return back here. Okay, so potentially we could see the markets return into this level here, to rebalance this inefficiency. Why do I think they might come here? Well, it's because of these candles. Okay, they are indecisive candles, and they're still inside the range of Wednesday's candle. So I think they might possibly return here. Now, if they don't return here, how am I going to engage? Of course, I'm going to observe the 4-hour time frame. I'm going to observe each daily candle closure, especially Monday's candle. Depending on how Monday candle closes, that will determine how I'm going to engage in the market. But there isn't anything specifically on the chart, because when we go through the 4-hour time frame, you see the 4-hour time frame, it's kind of like in consolidation. Okay, someone might see it as a market structure shift, which is very possible. This is a change in the state in delivery, and that's why if the market trades below this low here into this gap here, this level, it's likely to be a torso. And if we blend time and price, key time of day, we could observe price action on lower time frame, probably maybe 30 minutes time frame, and see if the markets are willing to expand into our buy side objective. Now, this is primary buy side objective, but we understand that there are premium levels we still expect the markets to trade into on the monthly time frame. This is simply to manage expectation, because we don't know what the markets are absolutely going to do when they get to 154. They could return back inside the range, or they could continue to expand high. Now, how do you beat the market if you are unsure when prices get here? Well, you have to take something off, because when you take something off, you've reduced the pressure of wanting to hold the majority of the trades into our long-term monthly buy side objective, and you allow the markets do what the markets would do. Okay, so this is Euro USD on the monthly time frame. Okay, so after Monday's trading, I'm trying to explain why I have this shock here, because last week we were talking about the fact that we wanted to see Euro USD trade here into 1391, which is the 3-month fair value gap. Okay, we have this gap here on the 3-month time frame. So that's the draw on the query, which overlaps the high time frame institutional order flow. That's data. So after Monday's trading, I wanted to justify technical reasons why I think Euro USD would go lower, because I also thought that we could see Euro USD trade above previous weekly highs, which I'm going to show very soon. And when Monday's candle closed bullish on dollar index, which of course validated the change in the state in delivery, and also qualified longs on DXY last week, I needed to qualify the reason why I could be short on Euro USD. And I went through the weekly monthly time frame first. And last week, if you recall, when we were talking about markets trading inside this week, now this week in itself is a bearish order block. Okay, the last up close candle prior to this move lower here, but not the change in the state in delivery. They are two different things. All right, so while we had the markets traded inside this week, I just graded the week on the monthly time frame, and this was 50% of the week, so that's consequent encouragement of the week, and I had that marked out, saying okay, this is the likely level we could see Euro USD trade from. And on the weekly time frame, that was the same thing I had here on the weekly time frame. This was after Monday's trading, and I was like, okay, fine, since we're seeing sponsorship from this week, all right, it means if I can validate a change state in delivery on Euro USD on the 4-hour time frame, I'm going to put on a trade. Okay, and if we go through the daily time frame, there was something else here. Okay, I saw after Monday's trading here, you can see this fair value gap. This is a BC, and which is likely to be a bullish fair value gap. But as soon as the markets closed below this BC, showing more bearish indication, and it became an inversion fair value gap, and this in itself qualified me to take a bet on Euro and say, okay, I don't care about what price action is, I will just have to submit to the system. And that was on a power time frame where you can see these consecutive upwards candles, 1 2 3. That's the change in the state in delivery. As soon as this candle closed below this candle, I went short on this candle and aim for sell side here, and I'm currently holding the rest of the trades. So on the weekly time frame, we can see that now we have a change in state in delivery here. Visibly, we have this consecutive upwards candle on euro, we could see the markets return here and sell off. Okay, because when the market returns here, that'll be fine. That doesn't mean the markets can open up and trade for sell side here and maybe more sell side here, because this is the drawn liquidity. But I would always like if the markets traded off levels like this, because if the markets open up and trades higher, it's classic for an ICT power of 3, and we could just, it's always better because if you hold trades off when they're coming off of levels, you can be confident, especially if you're trading on the high time frame, that whatever stop loss you're using around here when markets trade into this level and validates a change in the 24 hour time frame, you can hold that position into sell side objective here. And of course, you have to take something off here first and here, because there are still going to be more setups. But this current market condition is not something I would advise for pyramids. And what pyramids are simply taking new entries as the daily candle continues to print in that direction, because we're still in consolidation. Basically, it's back and forth. Okay, in fact, I may be wrong about this week's price. This market could literally open this week and begin to trade higher and very deep inside the range and close. Then we have December doing all of these things. So this is just based off of how last week's candle closed. Last week's candle closed below these two upcliff candle. So we have our auto block here and we have the draw on the liquidity here. So ideally, we want to see the markets return here first and sell off into sell side liquidity here. So I'm currently exhausted and out of breath. I think we'll end the commentary here. So I hope you found this one insightful. Until the next one, be safe.